This chart tracks a $100 bill over 60 years. In an S&P 500 index fund, you'd have $45,000 today, but in Berkshire Hathaway, it sits at $6.1 million. That discrepancy requires a specific mathematical reality underneath, a structure of leverage engineered to push returns higher. We often view Warren Buffett as a folksy guru who reads balance sheets and sips cherry cola. In reality, he spent 7 decades building a custom container to hold his assets, designed to prevent the internal leaks that destroy most long-term wealth. High management fees, forced selling during panics, and the steady drag of taxes, these 3 forces cap the growth of a typical investor. Buffett spent his life slamming the door on all of them. Historic wealth is the byproduct of capital protection. Analyzing a balance sheet is secondary to the structural engineering required to shield the resulting gains. When Buffett started his first investment partnership in 1956, he avoided the standard industry management fee. Instead, he took a 25% cut of profits above a 6% baseline. By leaving that cut inside the pot, his personal wealth grew faster than the fund itself. His piece of everyone else's gains stayed in the machine, compounding at the same rate as the capital he managed. This mechanism, known as carried interest, transformed his role from service provider to owner. He was no longer trading his time for a paycheck. He was accumulating an ownership stake that self-replicated year after year. But the partnership had a design flaw. The money belonged to his clients. When the market crashes and assets are cheapest, frightened investors notoriously demand to withdraw their cash, forcing the manager to sell at a loss. Buffett dissolved the partnership in 1969 to solve this vulnerability. He rolled his winnings into a dying New England textile maker called Berkshire Hathaway, using the company as a permanent holding vehicle. By converting client funds into corporate equity, he created permanent capital. A shareholder can sell their stock to someone else, but they cannot withdraw the cash from Berkshire's bank accounts. No panic could ever force him to liquidate his assets. A permanent fortress is only effective if it has a steady supply of cash to invest. In 1967, Berkshire purchased a small, ordinary Omaha insurer for $8.6 million. This acquisition provided access to float, the capital an insurer holds during the window between collecting a premium and paying an eventual claim. If the insurer breaks even on policies, the math flips. Customers are effectively paying the company to hold and invest billions of their dollars. Buffett deployed this zero-cost leverage into capital-efficient, high-margin businesses like See's Candies. He used the insurance float to buy whole companies during the worst market conditions of the 1970s. The final structural advantage plugged the tax leak. Berkshire has not paid a dividend since 1967, and Buffett never sells his personal shares. By keeping the wealth inside the corporation and avoiding personal taxable events, he essentially secured a 60-year interest-free loan from the government. Every dollar that would have gone to taxes stayed in the machine to keep compounding. This architecture faced its ultimate test during the 2008 financial freeze. Credit dried up, margin calls decimated traditional funds, and the smartest investors on Wall Street became forced sellers. Buffett was immune to the panic. His permanent capital and constant float meant no lenders to pay back, and no clients to withdraw funds. He weaponized this stability to act as the world's only buyer, dictating multi-billion-dollar bailout terms to desperate giants like Goldman Sachs and General Electric. Investment skill is secondary in a crisis. The actual power belongs to the investor whose capital structure prevents it from running away when the market crashes. 70 years of compounding made the machine too heavy. By 2026, Berkshire held nearly $400 billion in cash and treasury bills. This friction is visible in his Apple stake. Buffett had to partially liquidate a $170 billion position simply because there were no other assets on Earth large enough for him to buy. At this scale, Berkshire is slowly converging with the broader market index. In recent years, it has occasionally trailed the simple index funds Buffett recommends to the average person. The scale of this fortune was decided by the architecture of the container. By engineering a structure that locked out fees, prevented forced selling, and deferred taxes for 60 years, Buffett turned a high-performing portfolio into an indestructible machine.